It seems just like a blink of an eye. It's very hard to believe that the half of 2021 is in the books. So for my update, while I focus on recapping the year that has been so far, I'll also be highlighting the risk factors that we need to be thinking about as we get into the second half of 2021 and beyond. Greetings, viewers. You're watching Aman Sangha, Independent Financial Advisor in Mississauga, Ontario. Now, for my mid-year update, as always, I'll try to break it up into three main components. We'll start where we are with our vaccinations, especially here in Canada. Next, I'll recap the year it has been so far. And then I would get into some risk factors that we need to be aware of as we get into the second half, primarily on the lines of multiples, inflation, and earnings. So let's get started where we are with vaccinations. Now, overall, the story from the graph is that the vaccination drive is in full swing in different phases in different parts of the world. But we here in Canada have been lucky that we've been able to get our supply chain, our supply of vaccines together. The public has been very open to getting vaccinated, and we have about 1/3 of our population which has been fully vaccinated. And the way the vaccination drive is out there, hopefully by the end of the summer, this graph is a lot closer to where Israel is or at this point of time, where majority of the population is basically vaccinated, which should set up us for hopefully a safe fall and a safe winter ahead. Now with that, let's move on to the second topic, which is about the index returns. Now, for our equity indexes, you can see that S&P TSX is the leader of a pack of which has been another good year coming on the back of 2020. Now, Canadian dollar has also appreciated, which has taken back some of the returns when they translated to the Canadian dollars. But overall, it has been a good year for the equity markets. The bonds have recovered some of their losses, but they're still lower from where they were at the start of the year. Now, if you were to project just the equity returns into the next half of 2021 and what it would look like, it could be a good run given the vaccinations are picking up and the economy is opening up. But could there be any potential spoilers out there? And that's where I wanted to focus the next few minutes on. So to get a context of the discussion, I want to start with where S&P is in terms of multiples, and I'll use PE. So if you look at PE or the CAPE, the cyclically adjusted PE ratio, both are trading at very high levels. They're not at historical highs, but they're still at very high levels. Now, I'm not saying that they couldn't go any further, but what we need to understand at this point is, given the levels that they are trading at, if we plot that against what we are getting as inflation, if there was a line to represent all these, it will look something like this. And where we are currently is at this point. So for a multiple where we are, the inflation would be very high. Now, this is the point of where will this inflation end up. If inflation is transitory, this dot moves back to the curve, and we are at the multiples which are currently reflecting in the markets. If inflation is permanent, then this multiple gives way a lot of almost half of its value to come back to the line, which means inflation would be a key variable to watch in the coming months. And I still believe it is transitory, but this is something that we cannot take our eyes off. Why? there is more data to look into it. Now let's start with the chart on the right. Like this is the S&P 500, which is trading at all-time highs. Now, despite it being trading at all-time highs, the short interest in S&P 500 is at historic lows, which is a little bit contradictory in itself, but it could be the hedge funds staying away because of the Reddit traders. It could be because investors are buying the Fed story. But if you plot where we are, the inflation and the 10-year treasuries, we are at this point, the red dot, which is again off the plot that we would get of these data points if we were to go back in history. So if inflation is transitory, this dot moves back to where it was. It is in line with the 10-year treasury yields that we are seeing. If inflation is permanent, this plot moves up to be in line with what the 10-year treasuries should be there to sustain or to be reflective of this core inflation. So based on how the inflation story plays out, Fed's hand might be forced, and they might be acting to raise interest sooner than what they've been telling. And they did point out to that in the Fed meetings that came out during the month of June. Now with that, I just want to conclude by saying that I'm generally an optimistic. I'm not saying the markets couldn't raise any further, but just the factor that this was a survey that was done in the US. It's about 400. So the data set is not very large, but for what is available, it's like people have been borrowing money to invest in the markets. So when I just put the three together, if it's inflation, earnings, and margins, that doesn't take, it doesn't take a lot to wreck this party if it were to get wrecked. Now, this could play out in the rest of 2021 into 2022. Only time will tell. But I think it is very imperative that keep our eyes on inflation as well as the earnings, and make sure that the portfolios represent or reflect the risk appetite that we have as individual investors. And if you need any help in terms of positioning your portfolios that are reflective of your risk appetite, if you want to have a look at them, given where we are in the markets, you know the number to call, 905-363-5035. With that, I just want to conclude my June update. Thank you so much for watching, and bye for now.